FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Financial Survival Network is brought to you today by Orin Resources, a junior exploration company with the appetite of a major. It's hot on the trail of the next globally significant discovery, creating enormous potential upside for you, the shareholder. Orin is one of the most aggressive exploration companies pursuing high-grade, scalable gold and copper deposits and has a premier 7-project portfolio, including its 2 flagships, Committee Bay in the Arctic and Sombrero in Peru. Orin's unparalleled technical team and highly experienced management has a history of success in advancing and monetizing exploration assets. No wonder Orin's been called one of the best in the junior exploration sector. Orin trades on the TSX and the NYSE under AUG. To learn more, go to orinresources.com. That's AURYN resources.com.
The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's for 29/19. That means that, you know what that means? That means that April is just about over. Economy is doing well. Market appears to be doing pretty well. Are you doing well? Well, that's the question. Hey, as always, we encourage your feedback, your questions, your comments. Email us, kl@kerrylutz.com. So someone is back with us who was here before. Her name is Crista Huff, and she is Crista, you're the lead analyst of the Cabot Undervalued Stocks Advisor. We welcome you back on. So we're looking at the market. So, you know, there was an old saying once upon a time on Wall Street, the tree does not grow to the sky, but it appears here that the tree is growing straight up to the sky, isn't it?
Another way to look at it is that there was such a storm last year that it pushed the tree all the way to the ground, but it was bending, it wasn't broken, and now it's bouncing back because the storm is over.
Oh, so it was a palm tree because they're like designed to bend with the wind. So the stock market,
and I think that's what it was, because we had 3 stock market corrections last year, and they had an awful lot to do with very negative media attention to the economy. While the economy itself was thriving, everyone was heading for the hills, thinking that there would be alternately high inflation, low inflation, high interest rates, lower interest rates. It was crazy.
Yeah. Well, I kind of called the last one that it wasn't the start of a bear market, but we still have to see if it's going to pull back now, how much it's going to pull back now that it's in fresh new high territory. So panics, greed, there's only fear and greed in Wall Street, the 2 emotions that drive it. And when you saw that pullback, it was only 20% or so, although a lot of smaller stocks, not in the indices, got really slammed, like 50, 60%. But what was your take on it?
I was not surprised at the February pullback or the October pullback, but the December pullback seemed pretty shocking. But I saw it happening hand in hand with just real scary news headlines that weren't relevant. The thing that surprised me, though, was how much the analysts on Wall Street were believing those headlines. And I'm thinking, you guys are numbers people, and you don't need headlines to tell you what's happening in numbers. You're supposed to be able to look at the numbers and know. So that's why I was relaxed about corporate America, profits, the economy. And yet the stock market was falling another, 10% or whatever in December. So it didn't make sense. But I knew that as soon as tax loss selling season was over, that there would be no more reason for anybody to be selling come January 2nd. And so I urged my people, hold on, January 2nd is almost here, and then start buying.
Yeah. Hey, good move. Good move. And so now, though, we're going to keep going higher. We're going to get a choppy kind of market with pullbacks, but then quick recoveries, kind of like what we've seen.
Right. The interesting thing about this year's upswing, especially with with all the markets, but especially the S&P, which I really pay attention to, is that it's been a real gradual uptrend that doesn't ever seem to stop. But pullbacks are always very, very normal. So what I would tell people, if there were people who wished that they had invested but hadn't, just wait for the first pullback. If the S&P goes from like 2944 where it is today down to, down 100 points to like 2850 or whatever, just invest some of your money. And if you're scared, invest a portion of it on a very regular basis, whether that's weekly or monthly, because no matter how scary the market gets over a few months, it always rebounds and it always starts reaching new highs again. And I'm not just making this up. Any person listening can look at stockcharts.com and key in SPX, which is the S&P 500, and you can key in, a 50-year time frame if you want. And you can see that after every single pullback, the market advances. And so the smartest thing for anybody to really do is to buy when everyone else is scared.
Mm-hmm. Well, that makes a lot of sense. So looking at it, though, it's risen now on fairly low volume, less than 100 million shares a day. That's below the norm. That isn't always a sign of real robust strength in a market, is it?
It's not necessarily a sign of strength, no. And then I read a lot of analyst reports and I see a lot of earnings reports compared to the consensus estimates. And those estimates tell us what Wall Street is thinking. And something like 80% of the companies that reported their earnings this particular earnings season, 80% of them have come in above the analyst estimates. That's a really high percent. That means that not only is Wall Street is still running scared compared to reality, and that means they're advising their clientele. They're lowballing everything to the institutional investors, the pension funds, the mutual funds. So you've got this pervasive feeling amongst all the folks who have the big money, and these are the folks who can move the market. I have this feeling that they haven't been participating very well. So it's not that they already took their money off the table because they think the market's too high. I don't think they really put their money back in very well after the December downturn. So I see that as a potential source of strength in the market over the next, 3 to 24 months as institutional money continues coming back in.
Interesting observation. I haven't heard that before, but it sounds viable. So what about the economy? So, jobs are still going pretty strong. Probably the most important and least manipulated, or least statistic that can be manipulated, is the new claims for unemployment insurance. Those are at 50-year lows now. I mean, how long isn't that usually an indicator that the economy's peaking?
Peaking or thriving,
Well, both.
We've been reaching record levels in a lot of areas, and then the next time that particular number is reported, it's better yet again and yet again. So maybe we need to just relax about the strength of the market and make a general assumption that it's been doing so well for so many quarters in a row that it can actually continue doing relatively well for many more quarters until we start to see actual red flags, like negative numbers. If the GDP drops, then we'll be like, oh no, will it drop like this 2 quarters in a row? Or if the CPI suddenly spikes. But until we get one of these extremely negative numbers, I would relax about long-term trends and say, hey, we're on a roll right now. I'm not going to worry today. I'm just going to keep my eyes wide open for what happens tomorrow.
Mm-hmm. All right. Well, it's reasonable enough, but usually you kind of want to get out a little bit ahead. And at some point, we're going to have a recession, aren't we?
Recessions are inevitable, aren't they?
Well, under the current
because it's
system.
just part of the economic cycle.
Yeah, the cycles. And the cycles always prove out in the end. So,
yeah.
But it doesn't look like it's imminent, does it?
No, it doesn't look imminent. So I watched the GDP numbers, and let's see, the last 9 quarters, I think they ranged between up 1.8% and up 4.2%. And it would be a negative quarter that would be alarming, and two negative quarters in a row, or that classic sign of, yes, we're in a recession. And then I would remind people that a recession does not mean the world has come to the end. It just means a low point in the economic cycle, and the economy continues to move. And businesses and, unfortunately, legislators continue making decisions that continue to change the economic cycle. So just because we're in a recession at some point in time doesn't mean we'll be there forever. Doesn't mean that everybody loses their jobs. It doesn't mean that interest rates go to 28%. So to a large extent, I think people need to relax about the word recession because it will come again. And I've lived through many of them, and they didn't really harm me to a great extent. Maybe I occasionally lost a job due to a recession, but maybe I lost one because, I wasn't a good employee or I was the wrong color. These things are so random sometimes.
Yes, they are. You never know. And I guess it's the fear of the unknown. Nobody's sure where this thing is going, but I guess we'll know when we get there. So you think there's still value? Are there undervalued stocks in the market at the current time with levels so high?
Yeah, there are. And I have a very specific investment strategy that I use to find undervalued growth stocks. And then I have a certain amount of them in my stock market newsletter. Right now I have 28 stocks in my Cabot Undervalued Stocks Advisor. And then I have, let's say I have 30 stocks in my list of what I call waiting in the wings, because I can't stick them all in my newsletter. So as I find them, I put them on my B list, and I just wait for an opportunity to plug them in and recommend them to investors. So as long as my waiting in the wings list is sort of chock full of good stocks, I'm not worried about the overall valuation of the market. But sometimes during my investing career, there are times when my waiting in the wings list gets down to something like 3 stocks. And that's when I know the market's really overvalued, or conversely, earnings growth is so pathetic that I can't find companies that meet my requirements, because I do look for companies that are projected to have earnings growth of 15% or more both this year and next year. And that's my first cut. If they make that cut, then I look at the price earnings ratio, I look at the debt levels, I look at the dividend, and then I look at the price chart. So there are these different requirements before I start recommending them to the public.
And you're not having any problem finding these stocks now, Crista?
I am not. I will tell you that the earnings growth situation has changed a lot, but everybody sort of knows that last year earnings growth was huge in corporate America. So this year it's not huge, which does not mean it's bad. It just means it's not huge. So a lot of companies that I follow, let's say their earnings growth slowed down from over 15% to something in the 5 to 12% area. And then in certain industries, they're supposed to have a huge earnings surge again next year, especially in the energy industry. So if someone were looking for something that would cause enough excitement for institutions to start buying and continue buying for quite a few months, I would say look in the energy industry, because we have some big earnings growth that's coming there. Whereas if somebody wanted stocks that had strong earnings growth both this year and next year, these are projections from Wall Street, the clothing companies and apparel and related things like the former DSW, which is now called Designer Brands, Abercrombie and Fitch, couple of stocks like that, Guess, fantastic earnings growth. And many of these, the share prices have been tossed aside, so you can get them really cheap if you're willing to just wait a few months for the market to re-embrace them.
What about the retail apocalypse? It seems to be heading full speed ahead, stores closing right and left. What about that on the overall impact, its overall impact on the economy?
Depends on whether they're selling their things online or if they're just, not selling products anymore at all, right? So many of these folks are just selling their products differently, selling them online, selling them through Amazon or through their own website. Some retail stores continue to thrive, like Skechers and designer brands and Guess. Some of these are thriving much more overseas with serious expansion, especially in Asia. So you'll find that with Skechers. So somebody might say, well, I never see a Guess store or I don't buy Guess. That was like yesterday's brand. Well,
yeah.
It doesn't really matter if it was yesterday's brand in your mind. Personally, what I think matters is the company selling a whole bunch of their products at a good profit? And so that's my bottom line. So I put on these blinders to people's opinions about the product, and I say, is this company making it work? And the answer is a resounding yes for quite a few of these apparel retailers. Now, in terms of other retailers, there aren't any on my buy list. Earlier this year, Sleep Number, which Sleep Number was my number one stock pick for the year because there are various, media outlets say, okay, give us your number one growth stock. And so I said, Sleep Number, and it went up a lot. I don't know, it went up like 40 or 50%.
It woke up, huh? It became woke.
Yeah, it woke. And then the earnings report came, and you know how sometimes they fall tremendously on an earnings report, especially if it's a small cap stock.
Sure.
So that happened, but it's still way up for the year, and the numbers are still very attractive. It's just volatile because it's small cap. But other than that, no, if you're thinking like Target and Dollar Tree and such, nothing, Macy's, nothing like that is on my buy list right now. So they're just not, the numbers just aren't attractive enough for me.
Yeah. Well, I know exactly what you're saying. And well, when you talk about Asia, growth in Asia, then invariably you get to the trade dispute between the U.S. and China. Is that going to get worked out amicably or with gunships?
Apparently, there's been lots and lots of progress. Trade agreements can be really long because they cover so many product lines. Looking back to the Trans-Pacific Partnership Trade Agreement, which was slightly different and involved more countries, but that thing was over 5,000 pages long. So when people think of the U.S.-China trade agreement, the average person might think, oh, this is like a 10-page document. Well, no. It's probably a 1,000-page document, and it has to cover, hundreds of products and industries. So, and they have to negotiate each of those products, whether it's going to be tariffs or VAT taxes or some kind of special spiff coming from the Chinese government, et cetera. So it takes a long time to negotiate these things. Fortunately, the Chinese premier has been saying very positive things out in public about advancing the trade agreement lately. So the market's reacting, I think the market's reacting well to that.
Hey, well, you never know with the Chinese. They say one thing, do another. And one of those things that we're just going to have to watch how it works out. But certainly the U.S. economy hasn't suffered for this trade dispute, which goes back to my premise initially, where I said there's no such thing as trade wars. Those only exist in people's minds. What we've really had here is a realignment of the relationship, and call it economic warfare, whatever you want. Finally, in Trump, U.S. had somebody who said, no more, you're not going to do what you've been doing. We're not going to put up with it. Right. Whether it'll work or not is another story. If they've gotten too strong, that they can disengage from the U.S. and go about their own way. Doesn't appear that way right now, though, does it? Right.
I think China is motivated to be engaged with the U.S. and to solve problems, so especially so that they can sell more of their stuff here. They're motivated. They want to sell their stuff. Their economy is actually not thriving, and it's propped up a lot by debt. And
kind of like ours.
I think we're going to move forward.
Kind of like ours.
Not that ours isn't.
Yeah, well, yeah, like when you bring up debt, that's the big 4-letter word hanging over the economy, and there's no political will, or there's no will, period, to even approach it.
Right. There's no political will to solve a lot of America's problems, and that I find that extremely frustrating. And we're talking the will on the left and the right. People in Washington are very comfortable with their status quo. So we can only, I think, pray for the bigger problems where we don't see any hope, and get excited over the problems that are maybe being resolved. And then if we can personally make an impact through volunteerism or using our intellect within our career, go for it, because these problems are, a lot of them, since they're not going to be solved by Washington, D.C., they need to be solved by people like you and me and, our friends, our family, just regular, intelligent adults who know how to, who understand numbers, who understand people, who understand poverty, et cetera.
Yeah, well, as my former law partner used to say, the situation is hopeless, but never serious. Hopefully that's the way it is here. Hey, Crista, we want to find out more about you, read your work. Where do we go?
If you go to cabotwealth.com, there are a variety of stock market newsletters. Cabot is the oldest publisher of stock market newsletters in the U.S., and they're based in Salem, Massachusetts.
Mm-hmm. Never knew that.
And if they go to cabotwealth.com/Crista, there's a special $1 offer for new subscribers to my newsletter.
Very cool. Well, we like bargains for FSN community members. All you out there, don't forget, any questions for Crista, myself, any comments, email us. I'm catching up now. It won't be long now where I'm fully caught up, but then you'll send me a few hundred more. I can count on that. The email address is kl@kerrylutz.com, Twitter feed @KerryLutz, Facebook page, Financial Survival Network. Whether you're listening to this on a podcast or YouTube, please subscribe, like, and share. Really helps me a lot when you do that. Helps get ideas out there like Crista's that you're just not going to fall over in the mainstream media, to say the least. Anyway, Crista, been a pleasure as always, and best of luck. We'll talk to you again soon.
Thank you so much, Kerry. Bye-bye.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.